All right, let's talk about something that's on a lot of people's minds. Crypto tax in the UK. If you've held, traded, or earned any crypto at all, then this is for you. The rules can feel like a total maze, right? But don't worry. Today, we're going to cut right through all that noise and untangle the key tax rules you absolutely positively need to know.
So, here's the game plan. First, we'll look at the two main ways HMRC comes at crypto. Then, we'll get into the nitty-gritty of capital gains tax. That's the big one for most investors. After that, we'll cover when your crypto actually gets treated as income. And finally, we'll talk about the new era of compliance and what it means for you. Okay, let's jump in.
Okay, Section 1. Crypto's two tax paths. You know, if there's one thing you really need to get your head around, it's this. The taxman, HMRC, looks at everything you do with crypto through one of two lenses. And trust me, which lens they use for you, it changes everything.
So, the million-dollar question. If you hold some crypto, do you owe the taxman? Well, the short answer is almost definitely. It really doesn't matter if you've got a tiny bit of Bitcoin sitting on an exchange or you're deep in the world of DeFi staking. HMRC sees it as a taxable asset, and you can bet they want their slice of the pie.
And here it is, that fundamental split I was just talking about. On one side, you've got capital gains tax. This is for you if you're holding crypto as a personal investment, and HMRC themselves say this covers the vast majority of cases. On the other side is income tax. This one kicks in when you're actively earning crypto, like getting paid in it or getting rewards from mining or staking. So it's what you do that decides how you're taxed.
So let's start with the big one, shall we? Section 2, capital gains, the investor's tax. Since this is the boat most crypto holders are in, let's break down exactly how it works when you're buying, selling, and, crucially, swapping your assets.
Now this quote, this right here gets to the very heart of how HMRC thinks. They are making it crystal clear. In their eyes, crypto is not money. Nope. To them, it's an asset, in the same bucket as company shares or a piece of property. And the takeaway from that? Well, it means when you get rid of that asset, when you dispose of it, and you've made a profit, that gain is potentially taxable.
So what in the world counts as a disposal? This is where so many people get caught out. It is not just about selling your crypto for pounds, swapping one coin for another, say trading some ETH for Sol, boom, that's a disposal of your Ether. Using your crypto to buy a coffee, that's a disposal. And get this, even gifting crypto to someone, unless it's your spouse or civil partner, counts as a disposal in the eyes of the taxman.
Now, let's talk about the tax-free allowance for a second. Think back to the 2022-23 tax year. Not that long ago, right? Back then, the allowance was a pretty generous £12,300. That means you could make over 12 grand in profit in a year before you had to pay a single penny of capital gains tax. Those were the days.
But here's the real game changer. From April 2024, that allowance has been slashed, all the way down to just £3,000. This is a massive, massive drop. It means that even smaller, profitable trades can suddenly become taxable. That nice, comfy buffer we all had, it's basically gone.
And this chart just shows you how dramatic that drop really is. I mean, look at that. Going from over £12,000 all the way down to $3,000. It's a cliff edge. And what it means, in simple terms, is that a lot more people are going to get pulled into the tax net for what they might have thought were just minor gains.
So what happens when your gains tip over that tiny £3,000 limit? Well, you start paying tax. For basic rate taxpayers, that means an 18% hit on your crypto gains. And for higher rate taxpayers, you're looking at a pretty stiff 24%. So yeah, let that sink in. The tax-free zone is way smaller, and the bill for anything above it can be pretty significant.
So how are you supposed to calculate your profit? You can't just cherry-pick the coins you bought at a high price to create a loss. HMRC has a rule for this called the Section 104 pool. It sounds technical, but the idea is actually quite straightforward. You take all of your holdings of one type of crypto, let's say all your Bitcoin, and you throw them into one big imaginary pot. This gives you a single average cost price for all that Bitcoin. When you sell some, your profit is calculated against that average cost, not the price of any single coin you bought. Okay, time to switch gears. Let's look at that other tax path. Section 3, when your crypto is income. This is all about what happens when you're not just buying and holding, but you're actively earning crypto. And this plays by a whole different set of rules. This table lays it out pretty clearly. If your job pays you in crypto, that's taxed as income the second you get it. If you're getting rewards from mining or staking, that's usually considered miscellaneous income. And it's taxed on its pound value on the day it hits your wallet.
The most important thing to remember here is that the tax event is immediate. The moment you receive it, the clock starts ticking.
And this brings us to a really nasty and potentially very expensive trap for anyone who mines or stakes. It's the double tax burden. So check this out. First, you pay income tax on the value of the coins when you receive them. Then, if those coins go up in value before you sell them, you have to pay again, this time with capital gains tax on the profit. Yes, that's 2 separate taxes on the very same coins. Ouch! Which leads us perfectly into our final and maybe most important section. Section 4, the new era of compliance. Because with all these rules and traps, keeping good, accurate records has gone from being good advice to being absolutely 100% essential.
So let's just quickly run through the most expensive mistakes people make. Forgetting crypto-to-crypto trades are taxable? That's a huge one. Same with not reporting your staking income. But on the other side, lots of people end up paying too much tax because they forget to claim allowable costs, like transaction fees. And maybe the biggest myth of all, believing that using an overseas exchange somehow hides you from HMRC. It doesn't. Your tax is based on where you live, not where the exchange is.
And this timeline shows exactly why being compliant is so critical. The era of being anonymous with your crypto taxes, it's over. By early 2026, a new global reporting framework called CARF will mean exchanges have to collect user tax info. And then, by mid-2027, HMRC will start getting all that data sent to them automatically from exchanges all over the world. There's no hiding.
So how does HMRC know what you're up to? Well, that CARF system is the big one on the horizon, a direct data pipeline. But they're already busy. They're sending out nudge letters to people they suspect owe tax, they have a disclosure service for you to come clean, and their data matching tech is getting more powerful by the day. The net is closing in from all directions.
So everything we've talked about today really boils down to this one final question. Your crypto records, they are ready, aren't they? Because with a much smaller tax-free allowance, higher tax rates on the other side, and a future of total reporting transparency, being able to prove your numbers to the taxman isn't optional anymore. It's an absolute must for every single crypto holder in the UK.